Alright guys, so in today's video I'm going to discuss how to roll a options contract, whether it's like a spread or like it's a covered call, or anything in general can be applied based off of what I'm going to discuss here in this video. So a lot of emphasis in this video is going to be put on like spreads for the most part. I mean, this spread that I got going right here is basically what I'm going to be talking about the most in this video, because put credit spreads, call credit spreads, sometimes they can end up being a loser and not so much a winner. But that's only if you don't understand how to roll an option and realize that, like, in basically almost any market condition, if you act on the rolling quick enough, you're going to be able to actually fix it instead of letting the spread widen dramatically to the point where it's just like there's no return and it's just going to be super stressful for you and it's not going to be worth it. But another thing that we have to take in mind is like implied volatility can really kick our butts when it comes to spreads. So we got to watch out for that. We don't want to pick a stock with too much of implied volatility. And then, I like to say that, I don't like to say this, I like to pick, spreads that expire in a couple of months from now, because if you get one spread that expires in a week from now, and like let's say you wake up the next day and like let's say you do it on the S&P 500, the SPY on Robinhood here, and let's say it tanks and you got a put credit spread and the share price drops like $10, that spread's going to be so wide, like to the point where it's just going like, oh my god, what do I even do with this? You can roll it, but it's just like it's super hard and it's a pain in the butt. It's just not worth it. That's why I choose options that expire 3 months out, or a month at the least, because if I choose them a weekly ones, they just the spread just gets so wide. Because like with this, I mean, Pinterest literally tanked to like $62 a share back here. What was it? Yeah, right here on March 8th. And then this spread, I have kind of a rule where I don't like the spread to double, because if the spread doubles, we're in a bad position. But sometimes I prefer that the spread only multiplies by like a half. And what I mean by that is if I got a credit right here of 202, I don't want the spread to increase to 303. So I don't want the spread to be worth 303. But in some cases, just the spread doubling is perfectly fine. That's okay. But if you really want to keep it safe, don't let it increase by half of the amount it's worth, because then if you do, then you're starting to get into like tricky territory. But if it doubles, you're gonna be able to fix it. But like I said here, Pinterest tanked to $62, and the spread on March 8th, when it tanked that low, only got to 365. Now with a weekly, that's going to be like, the spread is going to be like more than double. It's going to like triple just like that overnight if it goes against you. So that's why I prefer to have a good amount of time. That way if a trade goes against me, I can fix it. So let's talk about how to roll these guys. So if for some odd reason, Pinterest on May 21st isn't above 75, which, I mean, it's kind of like, I'm not sure. I think it should be, but I'm kind of keeping an eye on it with the earnings coming out next week. That's what I'm kind of concerned about. But I did notice that Snapchat kind of bumped up with the earnings here yesterday, so I think Pinterest might do the same thing, hopefully. But if this does not work out for me, all I have to do is, so here, let's go back here. So this spread's worth 275. Now, I don't think that you can move it out to the following week after that, because I believe the spread's kind of worth about the same amount. But This is basically all you have to do. So what I would do in this situation is I would close my original spread, and I would do this all in one transaction. I'll show you how to do that. But what I would do, like I said, is I would close my other spread, and I would just reopen a new one. So I would just go over here, and I would sell this put, and I believe it's underneath here, and I go all the way down here, and this spread is worth 287. And if you get a fill on that, you might struggle because, like, what is this, 288? Yeah, you might get a fill on this, but see how it's worth 288, because the options that expire later on are always going to be worth more. So all you have to do literally is just close the original spread that you have. So that was worth 288. You saw that, right? So this one's worth 275. So we could give this one more week to work out for us, and boom, there you go. You just rolls it out a week, and then all of a sudden the next week comes and the share price goes right up above 75. Well, there you go. You just won. That's pretty much how you roll them. So if we are going to do this all in one transaction, we'll just go all the way up here, and this is how we would do it in one transaction. So since we did sell a put for May 21st, well, now we got to buy that put. So we'll go ahead and we would buy it, and then we would, oh wait, no, I didn't do that right. We'd buy this one down here. No, I did do that right. So you got to buy this back, and then you have to sell this one. And then boom, there you go. And then you just click continue, but instead of clicking continue, we're going to actually go all the way out, and hopefully I can nail this. So we're going to, same strikes here, we're going to sell this one, and then we're going to buy this put underneath it. So same exact strikes, and as you can see here, so we're closing this spread that expires on the 21st, and we're rolling it out another week. We're giving the trade more time to work, and as you can see here, we get a total credit of 12 cents. Now, that's what we would do if we didn't think things were going to work out. And then we just click continue, and we would obviously do two credit spreads because I have two of them open right now, and boom, there we would be good to go. That's all we would have to do, and then review the order and send it off. And if it doesn't get filled, which, like, I've noticed a lot of spreads like the next week after aren't worth very much more, and in some cases you might have to suck it up, and you might have to just go all the way out here to, like, June, August. Just keep going out until you find a spread that is worth more than the spread that you have open. So basically all I would have to do is buy a put right here, and then sell a put above it, and see how that's worth 285 right there. And then you just find something that is worth more than your original spread. It's as easy as that. It just has to be worth more than this, and that's how you roll it. That's why it's a never lose strategy. Now, if the market happens to tank, this is where, like let's say the market crashes like it did in March, and let's say Pinterest loses a third of its value. Well, you really, really got to keep an eye on it right here. And this is where you would just turn it into a call credit spread. So all you have to do is basically find a call credit spread that is worth more than 275. So it's probably going to be in the money, but it doesn't really matter because your put credit spread's already in the money. So you literally can just move this around until you find one that's worth more than what your original spread is. So let's go ahead and let's find one here. So obviously we're not gonna get anything right here. So like this is in the money right here. So like I said, your put credit spread's in the money, so it doesn't matter if your call credit spread's in the money. You're just trying to save the trade so you don't lose, and you're trying to manage it. So we'll just go ahead and let's just go up to let's pretend we're just tanking right now. So we'll go to right here. I think this is right. I don't know if it's this way. I always get them mixed up. So right here. Okay, so you buy a call right there, and then you sell a call. So no, that's not it. That's a 70 and 65. So 70 and 65, because you know how the other spread we had 75 and 70, so that's $500 in collateral. So all we would have to do, this is a debit spread. It has to be the other way around. That was wrong. Pretend you didn't see that. Why isn't it? Here, let's just get rid of this. Okay, so what did I have? I lost my track here. I always get the direction the wrong way. So it's the call debit spread. So we need to unclick this, and we need to change this to 65. So we have the sell call right here, and then we have the buy call right here. And that should be a call credit spread. Okay, so you see how this is worth 283? That's worth more than 274, I think it was, or 275. You know, for my put credit spread. So we would just basically, if the market was tanking, this is how we would, you know, roll it to a call credit spread, because we're worried about that. And then boom, this just, it makes it like a never lose strategy. So, you know, that's two approaches to it. I mean, there's other ways around it, but I'm not going to get into it. But that's basically like a approach to rolling. If, you know, a spread goes against you, and if you have a bullish thesis, then you can basically just give your trade more time to work with the same strikes. Or if you think that the market's going to tank and it drops way below, you know, your strikes, you just turn it into a call credit spread, but you just have to kind of roll it in the money. And this is obviously in the money, but like I said, so was your put credit spread. So what's it going to hurt if your call credit spread is in the money? You know, and eventually the market's just going to decide what direction it's going to go. And if it's just going to keep tanking and tanking and tanking, well, you basically can just wait it out. And then if it rises again, you can just go right back to the put credit spread. You just got to put it in the money and just keep working around it. Nobody's going to exercise this on you, even if it's in the money, because it has intrinsic value and extrinsic value, and they're not going to set money on fire. So I hope this helps you guys out and makes you basically win every credit spread that you ever open, because I hope it does, and I know it will, but I'm not a financial advisor like I always say. So I wish you guys the best of luck with all your trades, and we will see you in the next video. Thanks for watching.